We know the what. We know how you're thinking about monetary policy going forward, but I want to ask about the why. You've said that a December move is justified and 3 maybe next year. But can you tell us why? What justifies that kind of policy?
So the unemployment rate is now at 4.2%. By historical standards, that's a pretty low unemployment rate. Inflation is lower than we might have expected at this stage. We're well below our 2% inflation target. But my expectation is that that's a temporary transition. And if you look both at surveys that the Summary of Economic Projections, the participants in the FOMC provide, as well as private forecasters, they're expecting inflation to be much closer to 2% next year. So my worry is that we get to a place that is unsustainable, and that can be reflected either in wages and prices starting to go up too quickly, or it can be reflected in asset prices going up too quickly. What we want is a sustainable recovery, and that would imply keeping the unemployment rate fairly close to what we expect full employment to be.
But a year ago, Eric Rosengren to Bloomberg News said that we'll presumably be very close to our 2%, if not our 2% inflation target by the end of 2017. I'm not picking on you, but that's the kind of forecast that has drawn some questions, shall we say, on global Wall Street?
Right. Well, if you look back to March, we still were expecting 2% inflation. And one of the temporary things that occurred at that time was the wireless pricing change that actually had a big impact on the current numbers. What we're trying to get is the underlying trend in prices. And so there can be relative prices that can change a lot. That's one reason why we focus on core inflation rather than total inflation, because sometimes we get big spikes up in oil that are not predicted. Sometimes oil prices go way down, and that's not predicted as well. So we're not trying to address all the relative price changes that occur in the economy. We're trying to get that underlying rate. And so the reported inflation for right now is quite low, but I think it's partly a reflection of temporary factors. We're about to have more temporary factors. The hurricane is likely to have had temporary effects on inflation as well. So oil prices are a bit higher because the refineries have been shut down in places in Texas that were affected by the hurricane. And some kinds of housing supplies and other things may be a little bit elevated as a result of the rebuilding that's going to go on. That's not something we should react to either. So we can have periods where we get relative prices that go down or up. We want to get that underlying inflation rate. My expectation is we will get an underlying inflation rate that'll be relatively close to 2% over the course of next year.
Well, the idea that there's these temporary idiosyncratic reasons for inflation being low on the domestic front is one thing, but inflation's low around the world. Have inflation dynamics changed?
So it's certainly a possibility that inflation dynamics have changed. I think it's too soon to make that prediction. One of the reasons why inflation's been low around the world is we've had a long, slow recovery from very serious financial conditions. Both in here, Japan, Europe, all experienced very significant recessions, very elevated unemployment rates, which meant that inflation was much lower than it would have been if we had stayed at a more sustainable pace for the economies around the world. We're now getting to a different stage of that cycle where, at least in the United States, we're already beyond what my estimate of full employment is. In Japan, they're close to full employment as well. Europe still has a way to go, but I would say that the labor markets are improving around the world, and that's one of the reasons why I'm expecting inflationary pressures to get us back up to 2% over the course of the next year.
Well, you say unemployment is below your measure of full employment. The inflation rate doesn't respond, though. Do you question yourself? Do you say, maybe I don't understand what's going on with inflation anymore?
So we certainly have to ask ourselves whether there's been a more permanent shift in inflation dynamics that we don't understand. I think at this point, it's too early to make that kind of judgment. Wages and salaries are slowly going up. They're still at a level that's relatively low by historical standards, but we're definitely seeing wage growth. We're definitely seeing the employment cost index go up, and those are indications of a tight labor market. And we should remember it's only the last couple of quarters where we've had an unemployment rate that would be below my 4.7% full employment.
So you still believe in the Phillips Curve model?
I believe that if labor markets get tight enough that you'll start seeing wage and price pressures over time.
Does the Fed have an alternative explanation if that model doesn't come through? If we don't see inflation start to rise again, then what do you do?
Well, we'd have to try to understand what the reasons for that are. There certainly have been a variety of explanations that have been thrown out. One would be greater globalization as a possibility. If you look at the imports that we have in the United States, it's not dramatically different than 10 years ago. So I'm not sure globalization actually does a very good job of explaining why inflation would be persistently low when we had very tight labor markets, but that's something we'd have to continue to look at. People talk about structural changes in the economy, but for a persistent change in prices, you need that structural change to keep continuing going forward. So the important thing is we're trying to get at that underlying rate of wages and prices, and it would be very unusual if we got very, very tight labor markets and there was no response. It would basically be saying labor demand and supply no longer works, or that corporations, as they start facing higher wages, are willing to continue to shrink their price margins. And my expectation is we will see, as labor markets tighten, wages go up, and we'll see that firms want to maintain their profit margins. And so with a lag, you'll start seeing prices move up as well.
You talk to CEOs all the time in your district. What are they telling you about their pricing power?
They're actually telling me that things are changing now, that they are seeing much more wage pressures. They're finding it more difficult to find employees now in a much wider range of job categories than it was previously. So before, it would be people in the computer industry that were worried about cybersecurity in pretty isolated areas. Now you're hearing stories that are much more general about difficulty in getting bank tellers, difficulties in getting bakers. These aren't jobs that you'd normally expect to be in short supply. So I think those are examples where we're starting to see the labor market heat up, and you're seeing it in wage increases in those places where labor markets are quite tight.
CPI today, retail sales, you've mentioned that the numbers are going to be distorted for a while because of the hurricanes. So how are you going to look at the data in December if the data aren't necessarily giving you an accurate picture of what's happening in the economy between now and then?
Certain data series are more or less affected by the weather, so we'll have to factor that in. A good example is the employment report. So the payroll employment number was quite low. The reason it was quite low is definitely hurricane related. It was particularly in leisure and hospitality areas where there were less employment. And that reflected the fact that for the employment report, if you're not paid in that week, you're not included as employed for the employment report on the payroll side. But on the survey, even if you didn't get paid in that week, you're still included as being employed. So the unemployment rate actually went from 4.4 to 4.2% unemployment. So between those two, the series that I would think to be less distorted would be the unemployment rate, which is from a survey that's not going to be as affected as the payroll survey, where it's surveying firms. So that's an example that we're just going to have to look through the data and try to figure out which data is most affected by the kinds of shocks that we've gotten from the series of hurricanes that have hit the United States and obviously devastated those areas, but also made a lot of our data less reliable.
We are talking with Boston Fed President Eric Rosengren worldwide on Bloomberg Television and Radio. You raise rates in December, maybe. Is the current level of interest rates, another rate rise, inhibiting growth in any way or keeping otherwise qualified people maybe from getting jobs, as some of your colleagues have suggested might be the case?
Well, we're expecting growth in the second half this year, at least at the Boston Fed, to be roughly 2.5%. So that's faster than we think potential is in the economy, and that would imply that the unemployment rate would keep going down. So we want to make sure that we don't get to a place where we don't have a sustainable continuing recovery. And so that's why I think gradually increasing rates does make sense. We're going to be at a point where potentially we get an unemployment rate below 4%. That is an area where I would expect to see more obvious trends in the wage and salary data, and we'll see if that actually does happen.
Claudio Borio, he's the chief economist at the Bank for International Settlements, has argued the only thing that low rates are doing these days is leading to an unsustainable buildup of debt, which will have its own problems down the road. Do you agree with that?
I mean, one of my concerns with low rates for a long period of time is that people do try to reach for yield. And that can be both households and firms, that if you're a household and saving for retirement, it is a problem if you're keeping your money in a short-term CD that's paying a very low interest rate and you start taking more risk than you otherwise would do. firms have that same kind of behavior. So I do worry that one consequence of very low interest rates for a long period of time is that people take on more risk, and then when something does happen in the economy, a negative shock occurs, that they're less prepared to be able to handle that. So that's one reason to want to normalize interest rates when we get to a point where we think the economy is likely to get back to 2% inflation and where we're already very close, if not beyond full employment.
Do you think there's any danger that the economy moves towards contraction in the next few years? When would you see this business cycle coming to an end?
So economists are fond of saying that recoveries don't die of old age, which is that it's not particularly time dependent. It really is a reflection of either policy mistakes that occur with fiscal or monetary policy, or mistakes that occur somewhere else in the world that generate results that we don't anticipate. So recessions are really hard to predict, and if you look at most private forecasters, they almost never predict them. So those unanticipated events, by their very nature, are difficult to predict. I'm not expecting a recession in the next year or two, and I don't see anything in the data that tells me that that's likely. But could there be some geopolitical or other kind of shock? That's certainly possible.
There are job interviews underway in Washington. I know you're not going to comment on prospective Fed chairs individually, but let me ask you this. How much sway does a new chairman have? Some people have different ideas about how the Fed should be run. Somebody walks in the door tomorrow, can they say we're going to change the way we do policy?
It is a committee, so you have to be able to bring along the committee. So leadership matters, and who the chair is does make a difference to how monetary policy evolves over time. But they do have to work with a committee. Frequently, there's a lot of influence that occurs from staff around the Federal Reserve System. So it's not just that the Fed presidents and governors. We have a very competent and staff that goes through and provides a lot of the briefing documents. So the change may occur, but it probably evolves relatively slowly. You normally don't see big discrete changes in central bank policy because there's a lot of role for the staff, and a lot of the people that are presidents were here before and will be here after.
How much influence does the President of the United States have over the Federal Reserve?
Well, it certainly has the influence through who they appoint. And right now, not only is the chair up, but there are a number of other slots open. So the president gets to pick those people, and those people do make a difference for how monetary policy evolves. So in that way, the president has a big influence. Once the person is in their position, it's a little like the Supreme Court, that there's a lot less influence once the people are in those positions. And that's by design. The goal is to have a central bank that's independent of politics. And so there is some involvement in the appointment process, but after that, hopefully whoever's picked is primarily focused on getting the right outcome for the American people.
Let me ask you a question for our radio listeners here in Boston on 106.1. You've talked about equity prices and the possibility that asset prices get distorted. ETFs, long only, mutual funds. Is there any imbalance there? Do you foresee any problems in the future?
So one of the areas that I've raised concerns in the past is the commercial real estate sector, where I think the valuations have gotten outside of historical norms. So that's an example where I would certainly be a little bit more conservative and worried that those valuations may not be sustainable over a longer time period. So I think there are areas of the market that people should take a close look at and see if they're comfortable with the valuations.
But you're good with the Boston economy right now?
The Boston economy is doing quite well, but I would say that we're seeing a lot of commercial real estate going up in Boston. We're seeing an unemployment rate that's getting quite low. So some of the things that I worry about in terms of sustainability in the long run are reflected in how well the Boston economy is doing.